Over the past few months, oil prices have been a major topic of discussion. Today, the state tax commissioner announced whether oil companies would get to pay less money to the state for an extraction tax. Our energy reporter Mary Kate Mannion was there this morning and joins us now with more. Mary Kate?
Well, Alan, oil companies missed out on a major tax break as the price for a barrel of oil in May was $4.38 higher than the price needed to trigger a reduction in the oil extraction tax. The tax commissioner tells us that this will create a great deal of extra revenue for the state. The running clock has been reset on the state's largest tax exemption for oil companies.
Big trigger would have been for all production, would not have been for just new wells, all production from wells drilled since April 1987.
In the current oil tax code, there are two tax exemptions, one nicknamed the small trigger and the other the big trigger. The smaller trigger came into play in February due to low oil prices. Companies have fracked 466 wells since then.
So there's that large inventory of unfracked wells that have been out there, and this has helped contribute to decreasing that inventory of unfracked wells.
Yet for the last 5 months, regulators, state legislators, and oil companies watched the monthly average for a barrel of West Texas Intermediate crude. If the past 5 months had an average below $55.09 a barrel, the large exemption would trigger, cutting the taxes oil companies would pay in half. But May just didn't make the cut.
The absence of the big trigger will be a big hit for industry. I think if we would have seen that trigger on, we would have seen that spur quite a bit of activity throughout the summer. But companies will just need to go back and evaluate their plans for the summer.
Without the tax cut for companies, more money will be going into state funds, like the Legacy Fund and the Strategic Investment and Improvements Fund, which can be used to build roads and other one-time projects.
We had forecasted 11 months of the oil tax being triggered. That will not happen now, which will result in roughly about $80 million more a month in collections, because the rate, instead of being an average of 6% effective rate, will be really at the top rate of basically 11 to 11.5%.
There is the possibility, if oil prices plummet this summer for 5 months, the large exemption could be applied in November. But the tax commissioner says the chances are slim. Now, a bill passed this last session will allow the smaller trigger to expire at the end of June and repeal the bigger trigger at the end of November. Under that legislation, as of January 1st, the oil extraction tax rate will be a flat 5%, and if oil prices recover to over $90 a barrel for 3 consecutive months, that rate will be raised to 1% up to 6% total. Alan?
All right, thanks, Mary Kate.